Good afternoon, and welcome to today's event, The Business of Data, hosted by CFA Society Chicago's Education Group. I'm Chris Vincent, CEO of the Society. Information on upcoming events can be found on the Society's website at www.cfachicago.org. Registration for this year's annual dinner on November 3rd is now open. If you would like to be a sponsor, please contact the Society's office. Today's discussion will be moderated by Catherine Clay, Executive Vice President, Global Head of Information Solutions at CBOE Global Markets. Kathy leads several distinct business segments, including CBOE Global Indices, real-time and derived data, market analytics, financial risk analytics, and execution services. She came to CBOE through the acquisition of LiveVol, a San Francisco fintech company. She was the CEO there. Joining Kathy for today's discussion are Sean Brown, CEO at YCharts, Jenica Gold-Thomas, CFA, FRM, Global Head of Data at Morningstar, and Michael Hunstad, Executive VP and Head of Quant Strategies at Northern Trust Asset Management. I will now turn it over to Kathy. Hi, Kathy.
Hey, Chris. Thanks
so much.
How are you? I'm great. Thank you.
Welcome to CFA Society Chicago and its members and guests. We're very happy to have you. We've got a great panel and an excellent moderator. I'll step out of the way. We're all waiting to hear what you all have to say. Thanks for coming today.
Thanks, Chris. Thanks so much for organizing this. Thanks to the CFA Society of Chicago for all the work that they put forth to get this great panel together and get this discussion underway. We all intuitively know that data is the lifeblood of organizations. If you're looking to grow and scale, it starts with data. All organizations want access to more data and to make that data more accessible, to drive innovation and to solve business needs. Today's panel will explore the business of data. What are the emerging trends? And where should we be looking to better unlock market insights and outcomes? A little bit more about our panelists today. Sean Brown, yes, the CEO of YCharts, but YCharts is an investment research platform that enables smarter investments, better client communications, and focuses on helping advisors deliver more value to their own clients. Jenica Gold-Thomas is the Global Head of Data at Morningstar and leads a team of over 1,700 data experts in different roles. Jenica is also notably a charter holder. Finally, Mike Hunstad is Executive Vice President and Head of Quantitative Strategies at Northern Trust Asset Management, with the responsibility for all quantitative equity and fixed income research, product strategist, and quantitative equity portfolio management activities. Welcome, panelists. It's great to have you here today. I'd like to begin this panel at the macro level, 30,000 feet, and then move down into more specific topics. As you know, business drivers that originate on the macro level change far less frequently than do more specific capital markets business issues, such as data latency and data gaps that create unwelcome risk exposures. But these macro business drivers exert considerable influence on our daily business activities, changing the shape of our investments and the demand for the different types of data. The effect of macro drivers on market data is often overlooked, our attention instead drawn to the more acute headlining issues. However, when acute and immediate trends are studied together with the greater, longer-term macro trends that so often underlie beneath the surface, the conclusions are more robust. And so I'm going to start with the panel, starting with Sean. How are the global macro trends in demographics, economics, politics, and/or culture influencing the demand for more and more data? Sean?
Yeah, long and short is it's overwhelming. You know, we live in a global economy now where you see the butterfly effect in play, where it no longer takes a jobs report or you know, a stimulus package to move markets. It could be a Kardashian or Elon Musk tweet. So The butterfly effect is real. Moore's law is real. Scale economies are now saying that data and processing are accessible, secure, and they're cheap. And we're seeing a world that's moving from zettabytes being the new terabyte. I look at my home and say there are just millions of things that are now known and knowable. My kids know where their friends are by pulling up a snap map, and they're able to ask Alexa 50 times a day questions they should know themselves, like, what's 9 times 11? They're asking Alexa. And then we're just seeing decentralization of information, and Reddit has as much influence now as any Wall Street analyst. So I think my long and short is there's an unquenchable desire right now for data to drive insights, which drive decisions. And the challenge I think people face is what's the minimum subset of data to reach the right insights to drive the right decisions.
Great point. Jenica, you want to take a stab at the macro themes?
Sure thing. There's really a lot to say here. Let me pick up on one, and I think I'll pick up on the cultural aspect as well. At Morningstar, we believe in long-term investing. History is on your side. You avoid frictions such as transaction costs, minimizing tax implications, avoiding short-term gains, et cetera. That being said, today's culture moves at a much more rapid pace, just to echo some of Sean's comments there. I mean, given the accessibility of information, it's really old news to point to the advent of the internet era, but really the revolution in digital accessibility over the past 25 or so years has led to what I'll call the democratization of information, and thus the democratization of data. And in the newer generation of investors, we're observing a higher degree of comfort with event-driven trading, sentiment-based trading. And it's great to see people investing earlier and earlier. And when you engage in event-based trend-driven trading, it's just even more imperative to have access to latest news, quotes, real-time information to be successful. So I'll add that comment.
That's great. Mike, what do you have to add to the macro conversation?
Yeah, and just sort of following on, as a society, we are clearly enamored by data. We measure, hundreds of thousands, not millions of variables every single day. Through these measurements, we identify all sorts of problems. We're great at using data to identify problems. And I think there's a perception that if I can measure something, then I can improve upon it, whether that's economic policy, political or social goals, whatever the case might be. But that's really where the hard part starts, because we have these thousands of variables and we want more of everything. We want to improve everything. But I think within the data world, the reality now is we're seeing that it's very much we refer to as a whack-a-mole problem. That we can't have 150 different objectives simultaneously that we're trying to optimize. To Sean's point, it's the butterfly effect, where everything kind of depends on everything else. It's a dynamic system. This requires a much deeper understanding of the data than I think really most people realize, because it's not just the data, it's the metadata also that we need to be focused on. It's the correlations between the data. It's the relationship structure between the data that is becoming so important. It's the feedback mechanisms within the data that are important as well. So variable A may change, and 2 months later that may influence variable B. We need to understand these sorts of things. So we need to identify what the true objective is. We need to understand that we can't optimize everything, simultaneously. And a lot of that, the problems stem from the fact that, we're in a situation now where we have a lot of data, but relatively little theory to guide us into what's the right course of action, what's the right direction. In the last century, we had a little amount of data and a lot of theory. That's kind of been flipped on its head. So we need to rewrite theory in the context of having much more data at our disposal. That's going to vastly increase the demand for data across all of these economic, political, social goals.
I think you hit it right there, Mike, with understanding the data, and the data is so vast. And so I'm going to go to Jenica. We're going to come down from 30,000 feet here, probably to ground level, and talk about understanding data. And it is important to understand what happens in this data factory that we talk about. How is data made? You can think about a concept about how is data made, And what are the emerging skill sets that are required in this manufacturing process? Jenica?
Sure, thank you. This is a detailed answer that a few minutes definitely won't do justice to. However, in my role as data producer at Morningstar, I can tell you it's a constant journey of continuous improvement. It always starts with understanding your consumer. What's the use case for this data set? How will it support these users' processes, workflows? Really starts there. From there, sourcing is a primary consideration, right? And you think about things like data harvesting. I mean, the sources are too numerous to list, but data can be sourced via regulators for things like legal filings, 10Ks, 10Qs, fund prospectuses, company websites, news. These days exchanges, Kathy, have a lot of data exhaust that can be monetized. And, by data exhaust, what I mean is really valuable insights and data sets that are created as a byproduct of primary business, right? So for example, on a trading venue, the goal is execution. However, who's trading sheds light on ownership analysis. Obviously, the order book hints at liquidity and can be used in liquidity risk modeling. Credit card companies here, obviously, to conduct transactions. However, consumption patterns in looking at that data can be very valuable and hint at company performance by analyzing sales, ahead of the next quarterly or ahead of the next earnings estimate being released. So, the sources are plentiful. And once you figure out the sourcing, really, you have to think about extraction. And 20 years ago, you may have heard the role data entry analyst, and you've got maybe a vision of someone with a PDF or a document on one side of their screen and a database entry system on the other side, copying and pasting values from source to database. These days, however, we're leveraging data science techniques just more and more in this effort of extraction. Things like natural language processing, automated conversion and translation to handle various languages, taking all these image documents, PDFs, really translating them into more structured formats like HTML or JSON that are much easier to parse. Additionally, if you think about, we're leveraging machine learning models and artificial intelligence really to provide inferences to our data analysts in terms of where that data can be sourced and extracted from. So from data entry analyst to let's call data research analyst. So now the job is more focusing on the interpretation of the data, the normalization, right? Developing that content expertise around it rather than scouring through documents, looking for a particular label or tag. So again, technology more and more these days. In fact, this year in 2021 in our job catalog, we released a new role, machine learning data research analyst. Really solidifying that the role is evolving as well as kind of how we're extracting data. After you get the extraction, really it's the analysis. And I think this is what Mike was speaking about, the need for more theory here. And on the one hand, you can tag information by embedding metadata. When you can think about that as making it easier to fish for relevant content down the line after you've extracted it. Classifying documents, information, news, all of this for subsequent processing, but really the analysis about the quantitative modeling exercises on top of it, creating the derived data. And this is where much of the differentiated data or the intellectual property is generated. So those quantitative skill sets are really critical. And along those lines, what skills are relevant was a part of your question there. So we're in the financial data space. I've got to say the CFA charter, at the risk of stating the obvious here, we love hiring charter holders, right? We know the rigor of the process. We know they're going to bring that financial acumen and expertise. Secondly, I'd say programming skills. The languages evolve, all right? 20 plus years ago when I started in the industry, it was C++ and Perl. These days, Python is in demand. I like to joke, none of these complex systems can be solved with pencil and paper anymore. So whether it's, database querying language, leveraging SQL or any other language, I'd say coding literacy is absolutely critical. I touched upon quantitative skills, but a lot of these analytics frameworks are really relying on pricing theory, statistical knowledge. And last but not least, I'd call out quality. It may not be thought of as a science, but frameworks like Lean Six Sigma that have been, built and let's say explored in more industrial type environments really can be used to perform root cause analysis and improve our collection and processing operations. So those are some of the critical skills I'd call out in the data factory.
That's awesome. And I think I'll go to Sean on this because I think a good follow-up question, Sean, for you is, what Jenica was teasing out is that, actionable data is the missing link between big data and business value, right? And so when you're developing these investment insights in today's age, it requires data, tools, and people, charter holders, as Jenica mentioned. Are each of these three legs of the stool at the same stage of maturity, or and are they appropriately harmonized, or where are we with those three elements of sort of the need for getting actionable insights out of data?
Yeah, so it was really interesting to hear Jenica kind of describe the data factory, and I think the takeaway from there is there's a lot involved in it. In the three-legged stools though of data, people, and tools, I think the data is the most advanced right now. The factory, the micro factory and the macro factories are pretty darn good. I think the thing we're seeing is people. There are never enough people. You look on Glassdoor over the last 5 years, the number 1, 2, or 3 most sought after job are data scientists. There is just an unquenchable desire for people. Tools. Well, tools are driven by people who conceptualize things and take it to code. And so tools are also not where they need to be, because you can have all the best data sources in the world, but if you don't know how to see the correlations and to spot the trends that come between data sets, you have challenges. So I would just say from my perspective, data's pretty darn far along. People are woefully short of data scientists and experts in machine learning and AI and all those things. And the tools are catching up, but they're far behind the data too.
Mike, I'd love to hear you comment on that. Yeah.
Yeah, sorry. I completely agree that the problem area is on the people side. There simply are not enough people that understand sort of the synthesis between a business problem and the analytics behind it. I'll push back a little bit though on our biggest problem is we have a huge amount of data out there at our disposal, but a lot of it is very dirty. A lot of it is incomplete. A lot of it just doesn't make a lot of sense. So while the data collection, I think, is advanced, we have access to much more data, every day. But being able to utilize that, the reality is that the tools that we have are incredibly sensitive to bad data. And I think that's one of the problems that the industry faces, is that our tools are built for perfect data sets. They're textbook data sets. So if you introduce even any kind of, whether it's incomplete or bad or whatever the case might be, it's a massive garbage in, garbage out. It's not even garbage, it's garbage in, garbage out times 10, in a lot of cases. So we wrestled more than anything else with the quality of the data over the tools that we have at our disposal.
So talk a little bit more about these tools, Mike, especially as a quantitative strategist. You're obviously looking for those signals that tell you to get in an investment, out of investment, make an asset allocation change. Like tell us a little bit more about how you actually get those signals when you are dealing with this data quality problem.
Yeah, so our bread and butter is prediction, and I think that there's a lot of myths out there when it comes to big data, AI, machine learning. We take very, very large amounts of information, we distill it into sort of feasible data sets. From that, we make our prediction using whether it's machine learning or any other kind of model. But the principles are always the same, that you need that good quality input to ensure that your output is consistent. Now, one of the myths that I hear a lot about is more is always better than less, or faster is always better than less. And I think there's a little bit of a misnomer around that, in that it really depends on what you're trying to predict and what the frequency is of what you're trying to predict. So if I'm trying to predict a relatively low frequency variable, like valuation measures within the equity market, it doesn't necessarily do me a lot of good to collect information on a second by second level, have tick level information to predict something 5 years from now. And I think that there's a sort of a misconception in the industry that we can always use huge volumes of data to predict anything, where in reality, the best and highest and best use of higher frequency data is for higher frequency predictions as well. And I think that's, one of the things that's little understood. Too often I find that in the industry, what we do is we take a whole bunch of data that we don't really know what the frequency or the decay is. We stuff it into some R package or Python module, and out pops some result. And we just expect that that's, that's a solid, reasonable answer. When in reality, we could have violated, 150 different rules of, machine learning in the process of doing that. So I think that it really takes an educated person. This gets to both Sean and Jenic's point. You need somebody that really understands what they're doing. There's a lot of data analysts out there that are, just enough to be dangerous, but it is exactly that. It's a bit dangerous.
Well, let's go to the volume of data that keeps coming up in every panelist's conversation here. And I wanted to, let's go to Sean on this. I want to know from you, what do you see as data sets that are really becoming commoditized and maybe are losing value, have already lost their value? And what are some of the more exotic data sets that you see available and attractive at this time?
Well, so we try to provide at YCharts, we try to provide a bunch of different data sets and tools to help investors make decisions. And the commoditized data sets are, the basic suite of technical and fundamental things that come from income statements and derived calculations coming from there, and analyst ratings and price movement and all that stuff. That was the superset of data that the world used to operate on, and that's how decisions used to be made. It's overwhelming now. The new data sets, the unique data sets that are coming out. Everything from the neat stuff that we all can grasp on to like ESG makes a lot of sense to us, to parking lot data to assess when is the company's parking lot full and what signal does that give on what the upcoming earnings release may be, to Facebook posts, to patent applications, to LinkedIn profiles, all the way to, you're seeing some neat things now, like people talking about thermal imaging on earnings calls to understand the perspiration and stress levels of executives, to understand if that may provide signal. So, to Mike's comment, I can't remember the exact analogy, but there was something like a correlation was seen between the price of pickles in India and the movement of the Australian stock exchange. And there were simply so many data sets out there that eventually you're going to see a correlation between two if you have enough data sets. And I think the interesting thing we're all struggling with right now as investors look for signal is, what are the right subset of these unique data sets that's actually meaningful and helpful in getting to signal?
That's interesting. I wonder if the perspiration on the brow of a CEO falls under the environmental part of ESG.
Could be.
But ESG is a big topic, and I'm not surprised that it gets raised in this panel. I remember years ago, you couldn't go to a conference or a panel and not hear high frequency trading. It's like a tick. ESG is really in that same sort of vein right now, but we can't not talk about it because it has huge implications, right, for the transfer of wealth across the world, and it's ever changing. And Mike, I'd like to ask you about your experience with ESG data. What are you using, and what do you see as the opportunities ahead for ESG data?
Yeah, so a very robust data set. We have many ESG data providers. Each of them use, hundreds, if not thousands of metrics that kind of roll up into their ESG composites. So there's been a lot of innovation on data collection and reporting of ESG related criteria or metrics. So that's kind of stage one. But where the industry really needs to, I think, put some thought is, how do you then form from those metrics accurate composites? So getting back to kind of what I was saying earlier in the conversation, we want to ideally optimize everything. So we want to optimize the E and the S and the G pillar, and within each of those pillars, we want to optimize all the KPIs, and within all those KPIs, all the metrics that roll up to those KPIs. But we can't necessarily do all of that simultaneously. So one of the things that needs to be worked out is, what are these ESG composites actually focused on? And the reality right now is, if you look between different ESG data providers, you see very low correlation between their scores. So a company can have a very high score in one ESG ranking, a very low score in another ESG ranking. That's not necessarily because of the underlying data. It's predominantly because of the philosophy of how those criteria are weighted in that ultimate composite. So I think when we think about data, it's not just bringing data in and cleansing it. It's also, summarizing it in these forms like ESG scores. There needs to be a lot more thought about the direction in which these composites are sort of motivated or face. At Northern Trust, we've developed our own ESG scoring methodology that focuses on financial materiality, to say I want to weight those metrics that actually have an impact on the company's finances and ultimately portfolio performance. So I think we just need to do more in this domain, as well as analyze what's the impact of the portfolio of implementing these ESG metrics. They can cause a lot of unintended biases in the portfolio if you're not really careful. So collecting data is just the start, and I think we've got a reasonable handle on that. Forming those composites is a lot of work to be done. And then sort of the tertiary stage is really understanding what the impact is on our ultimate portfolio.
Will there ever be a composite standard?
There may be. We utilize something called the Sustainable Accounting Standards Board, which is a third party, basically it's like FASB or GASB, that sets their criteria to say these are the issues that are most materially, financially material, for certain industries. I think that's a step in the right direction. We also use a organization called TCFD, Task Force for Climate-Related Financial Disclosure. Similar kind of function. They're putting standards down on the books to say this is how we should think about the materiality of issues. So we're at the nascent state of that, but we're kind of in, ESG is today what financial reporting was in the early part of the last century. It's a bit like the wild, wild west, but there are these organizations that are coming through to offer some standards.
Jenica, I'd love to hear you comment on the ESG. I know Morningstar has a very predominant ESG group. And I also would love you to talk about something you referred to early in the conversation, which was all the regulations that provide an opportunity for data. And so you could touch on the ESG and the regulation across the world, and it's dynamic and ever changing, as an opportunity. That would be great.
Sure. I mean, tying those two together, I might call out SFDR, right? So the Sustainable Finance Disclosure Regulation, which is really kind of rolling out and going into effect now, which was introduced by the European Commission, but really to put standards on kind of ESG disclosures so that, financial advisors, investors, really levels the playing field for market participants in terms of understanding both the impact and, kind of what's contained under the hood in terms of these financial products that they're buying. But stepping back, I would say more broadly, look, there's a dizzying array of regulators, right, in the US and abroad. I mean, I think about just 4 clusters of them, kind of depository regulators covering the banking space. You got the OCC, the FDIC, Fed Reserve. When you move into kind of the capital markets and security markets regulators, SEC, CFTC, you've obviously got FHFA regulating the GSEs, and more recently, consumer protection regulation, I think is interesting, on the creation of CFPB, by Dodd-Frank. So again, this is just in the US and just at the federal level, but it abounds. And really, each time a new piece of regulation comes out, there's compliance requirements, right? And so, being a regulated entity, there's just big examples of how that creates a need for new data and really kind of forces this question of build, buy, or partner, right? So I need a new system in place. Do I need to build my own data ecosystem to track, measure, build this, or maybe should I outsource it? So it really is driving a tremendous demand for new data sets. A couple that I might call out is KYC, or know your customer, know your client, right? And FinCEN requires financial institutions to verify not only their direct customer identities, right, but, all the respective beneficial owners. And so what that drives, it ties into anti-money laundering efforts. But as a result, data sets like entity data in viewing the complete, kind of corporate hierarchy of all these various entities becomes very important. All the various relationships between subsidiaries, sub-entities, and things of that nature. So it really drives kind of creation of these data sets that requires scouring multiple sources, registries to really collect and aggregate. Reg BI, you think about, regulation best interest and, the SEC in particular, but also in Australia, this is similar regulation known as DDO, really hints at kind of best interest or suitability. And again, this is about, the distribution of financial products and the obligation to understand your target market, right? And to understand actually more about the individual investor who's consuming these products. And so I think that drives also what I think is very interesting, what it drives is the opportunity for more personalization, because the more that you collect kind of preferences and tolerances and kind of what an investor's goals are, the more you can really tailor the portfolio to them. And I think portfolio personalization is also a big theme that we're going to continue to see, in industry. And there's really a lot of opportunity there. But I could go on and on, some of the FRTB regulation that's come out of Basel III, each time, the landscape evolves, there's that same race for new data and figuring out how we're going to satisfy those requirements.
Sean, I'd love to know, since you deal with investment advisors, Jenica's talked about a couple of things that are really interesting with respect to regulation, ESG, customized portfolios, these trends that seem to be emerging. What do you see from your perspective in your business?
Well, as a tools company, we have a really solid appreciation for one of the biggest challenges is to find what are the right data sources. We just talked about the lack of standards even in ESG. Our customers come to us expecting us to have done our homework to figure out the right data sets. Of the 400,000 economic indicators we've got, or 80,000 funds and 100,000 potential models, it's overwhelming, the amount of sheer data, which then leads to the ability to, with a good tool, to synthesize that and screen for things. But even when you screen, you get down to 10 options and you say, wow, that's a lot of work to do. So I think the big thing that we're seeing more and more now is there's almost a bifurcation of what people need. Some people need tools that help them harness the data and develop their own insights. Some people just want to know what's the signal or what's the recommendation. And they're saying, listen, I'll pay a premium, just do all the work for me, because I honestly don't have the time to take a look at the 10 great choices you gave me down from a list of 400,000 choices. I don't even have time to do the 10. So we're seeing people who are, especially in the advisor community, who are saying, hey, if you understand the regulations and you understand my obligations, you understand Reg BI, and you understand how I'm thinking about screening down securities, can you do it for me? And let me know what you came up with, and then I'll take it from there.
Yeah, I mean, it brings up a great point about, users in our day and age of data are really spoiled. They get things real time. And I know Mike said real time is not necessarily in all situations important, but for consumers, it is important. They want things as fast as possible, and they want things as personalized as possible. I think I don't know if it's true or not, it could be an urban legend, but there's a statistic that basically says if Amazon sent you just random things based on the data they have on you, you would keep 70% of what they sent you. And so we have this trend of consumers really being spoiled with, companies knowing what they want and they need. So I want to ask, and any panelists can jump in here, what should we expect to see in the coming years that will meet this growing demand of instantaneous information and personalization? Who wants to take that?
I'm happy to jump in here. On the personalization side, from an asset management perspective, and we deal predominantly with institutional clients, but this is true in the RIA space as well. It's all about customization of portfolios and customization for a specific outcome. And I know that term is overused, but when you think about individual clients, obviously they want to craft their risk and return profile, but they also have different income requirements. They have different liabilities they're trying to defease. They have different tax situations They can have very different ESG and SRI goals. So more and more, as additional constraints or additional objectives are placed on the portfolio, this really lends itself to customization. And to Sean's point, I think one of the things that's driving this is that you do a screen and you still come up with dozens of potential options, like which do you choose? Well, maybe the option that gives you exactly what you want to your own specific blueprint is right for you. Now, to do that, that requires asset managers to completely rethink their own technology and data platforms, because what we used to have in terms of scalability of products, the ideal situation is you have a handful of products that are, have billions of dollars in each. Now it's scalability of the technology platform that creates those strategies. So it's sort of what I refer to as Taco Bell scalability. If I have, 8 ingredients, I can manufacture 150 different things from those 8 ingredients and still be scalable from a technology perspective. But that requires an enormous amount of data on the back end to say that I can manufacture anything, whether it's equity, fixed income, ESG, multi-asset, et cetera, and do it in a customized way to meet your specific needs. It basically means that I need almost everything that's out there. So that is a challenge in and of itself.
And it's interesting what we're seeing in this industry, where when you talk about the securities that ultimately people are trading into, the world was fairly simple when there were stocks and derivatives off of stocks, and then we decided to make it easier for people by creating funds. But the number of funds exploded. It goes from 25,000 equities to 80,000 funds. And then people said, well, wait, this whole concept of a 60-40 portfolio or a 70-30, that makes a lot of sense. Let's make models. Now there are tens of thousands and soon to be approaching hundreds of thousands of models. So the continued effort by asset managers and advisors to make the world simpler is actually in many ways making the world much, much, much more complex. And it's just getting tough to sort through it all. And it's especially getting tough to sort through when you have a model to really understand that if you look across your various models and funds, what is your true exposure to Apple? And I think that's one of the things that we're seeing is even this world of the simplified model portfolio. Advisors are saying, you know what, I can't take it off the shelf anymore, because what I found out is the exposure to China or the exposure to tobacco or the exposure to something else that my client doesn't want. When we did the X-ray analysis underneath it, we found it doesn't meet the needs. Now we actually have to tweak this model, and now we're back to the stock part of the equation.
Yeah. Well, we can't have a panel without talking about the pandemic. So I'm going to ask a pandemic-related question. I'm going to go to Jenica for this one. COVID-19 accelerated the digital transformation for many businesses. As the pandemic catalyzed a fundamental and likely permanent shift in the way people shopped and did business, what digital transformation did you see in the capital markets? And are those shifts temporary or lasting?
Well, I'll start with a bit of a personal anecdote, which is because my husband, who's run the trading desk for the better part of 3 decades, for that entire time thought the job couldn't be done except for in person, right? Never let anybody take a day off. There was no work from home. They all sat on a big, long trading desk. But I think, the past 18 months has proved him and many of us wrong about a lot of different shifts in the capital markets. Also, though, I do kind of want to pick up on this trend about portfolio personalization, because I think there's so much there. And again, as people are interacting in different ways, not sitting down face to face with your advisor, I think there's tremendous power in that, and Mike had talked a bit about product creation, and maybe you think about optimization. Hey, I want to optimize for these different factors or these signals of importance. But I think creating frameworks, things like similarity frameworks to help investors, again, sift through the dizzying array of product on the shelf is going to be really incredibly important to continue to drive that personalization effort. I also, Netflix is hailed all the time for knowing our preferences, but can you imagine opening your screen and being told, hey, your portfolio is in good shape because of X, Y, Z, and by the way, you might want to check your exposure to China because I did a full look through on all the fund of funds and the fund of funds throughout all your models, and I know your preferences and tolerances and your goals and what outcomes you're looking for, and I suggest you look at corners A, B, and C of your portfolio. And so that's the kind of insight that I think people are really looking for, and more are going to be expecting. I think we've got the data, but I love that point about the tools, right? We need to really build up the tools and the solutions behind it. Again, to continue just to democratize this. It's not just for institutional investors, it's for the end investor as well.
Great. So we have a few minutes before we're going to go to the Q&A, but I want to ask each panelist, one question, which I think everyone would love to hear your answers to, which is really, what does the business of data look like in 10 years? I mean, Jenica, you just gave us a future state of what it's going to be like to open your account and see exactly what you're supposed to do for your own portfolio and risk tolerance. But we'll start with Sean. Sean, 10 years from now, what do we look like in terms of data?
Oh, I don't have a good answer to that question. I mentioned the world quickly moving to zettabytes, and we've got a 3 terabyte database right now that is growing exponentially. And so what I want the world to look like is, I want the world to look a lot simpler. I want the world to look a whole lot simpler for that end investor. Professional investing entities, they can deal with all the complexity. I want the world to look real simple for Main Street. So, tying that to what we do, we're just trying to make all this complexity a lot easier. But I have no clue how we're going to do it right now, because there's a lot going on, and there aren't enough people. The tools aren't yet there. And, to Michael's point, even where the data is ubiquitous, it may not be as clean as it needs to be or mature as it needs to be. So I don't have the answer to this one.
I'm going to go to Mike, because I think Sean just said he wants your world to stay complex. If I heard you right.
I want Mike to stay employed for a long, long time.
Yeah. No, we'd like to simplify things if we possibly can.
How do you see it? How do you see it playing out?
Well, I think asset management in general in 10 years will look a lot more like a tech firm than what we now refer to as sort of a traditional asset manager. I think they'll be reorganized around not traditional asset classes, but recognize, I think it was Jenica mentioned this earlier, that asset classes are just sort of a convenient way of separating securities, but in reality, a lot of equity securities have duration, they have interest rate exposure. A lot of fixed income securities, especially high yield, have some equity exposure. If we're trying to really simplify things in the future, we got to boil it down even more than that and say, what are the key drivers of our portfolio performance, and really organize asset management around that. Now, how do you do that? Well, you need people that are probably a hybrid of what we have today. We have very, quantitative analytical people. We have people that are more on the sort of client-facing end of the spectrum, but increasingly we need, I think they refer to them as T and pie-shaped professionals, people that can kind of do it all. That's going to be much more in demand. I mean, it's in demand already, but it's going to be much more in demand going forward. They have a depth of technical skill, but they can also collaborate across the business. They have those interpersonal skills. From a business perspective, data is going to be much more of a centerpiece than it is today. That's going to require a lot more governance. So there's going to be a lot more compliance related issues around data acquisition than ever before. And then I think increasingly a bigger focus on metadata, meaning that what do we do with this information that we have, and how do we make sure that we're utilizing that appropriately? So moving in the direction perhaps of a tech firm, we're never going to lose it completely. We're always going to be asset managers, but without question, some of those roles are going to change.
Yeah, I might pick up on that metadata comment. That's just so critical and so important, right? And as the sea and the ocean swells with all of this data, whether it's an ocean or, a vision of a river passing you by, right? And you want to fish for a particular content, data needs to be discoverable. And I think metadata is a great way to make that happen. So also don't know what it's going to look like in 10 years, but it's definitely an enjoyable ride. One of the things these days is data ecosystems, right? So you can think about that internally, or a lot of people think about it externally, right? Putting a whole bunch of data on the same platform, making it easier to kind of join and elevate the value that any one given content set can offer. But I also think, implementing this internally at organizations, getting rid of data silos, creating more of these enterprise level, data platforms, data lakes, et cetera, to make it more readily available And I think it ties into that governance comment that Mike made, right? Because then you can put central governance oversight over it. You can cleanse it once and put some nice entitlement controls around it and make it easily accessible to all the departments of your organization, right? Not just marketing need to understand, you know, what are the trends and the hits on your digital properties. And so I think these data ecosystems internally to businesses will drive a lot of growth as well.
Right. Well, I think that's as close of a glimpse in the future as we're going to get. 10 years is a long way out, but I think Sean talked about quantum computing. Definitely a larger appetite for data is in our future. And I think that's a consensus with the panelists. So thank you all for that. The free form, we are going to move to Q&A right now. So I'll read the question and feel free, panelists, to jump in where you want to. The first question is an interesting one coming from an exchange and working with these companies on a regular basis as partners for our distribution of data. The question is, how are Bloomberg and FactSet able to maintain such dominant market share when all data is democratized?
Happy to address that. Sorry, go ahead.
Go ahead, Michael.
Maybe I'll start, you can jump in, but it's not just about the data set, it's about the piping and getting access consistently, smoothly, without error is critical. We know that we can source the data from myriad places, but it's really about how it flows into the system is absolutely critical. We're moving to a cloud environment utilizing Snowflake, where we can access FactSet data directly from Snowflake. It never has to exist, within our internal system. So that alone continues to make FactSet very attractive.
And I would just add to that, I think as data consumers are trying to keep up with all of these new data sets and all of these new things out there, sometimes you want something steady that you can rely on. And whether it's Jenica's great Morningstar data or Bloomberg or FactSet or S&P Cap IQ, it's a safe place to hold on to something as you try to evaluate all these new data sets for their latency, their cleanliness, their signal. And so I wouldn't predict in 10 years market share will look the same, but I think right now people have their hands full trying to look at new things.
That's right. And one other aspect to that, I think, is the network effect, right? And for sure, Bloomberg very much benefits from that. But also tying it back to some of my comments earlier about regulation, a lot of data consumers actually are regulated entities. And so there are model validation standards around that. And many times, the tried and true can get you there faster and might actually reduce maybe some of your regulatory and compliance burden. So I think there is a network effect embedded in there as well.
Great. All right, moving to the next question. I think we touched on this a little bit, especially Mike and Jenica. The question is, though, we've talked a great deal about the data business in the public sphere. What about the data business for private markets, funds, and investors? And how are the challenges, opportunities, and trends different there?
Well, there's less transparency in the private markets, right? Whether that's private equity, private debt space. So there's a huge opportunity there. We're doing a lot of work in that space with PitchBook on the private equity side. And what's interesting is I think there's an opportunity. One of the opportunities is really tying together that private data with the public markets, right? If you think about taking private portfolio companies public and what do you need to know from a cohorting or composite point of view, I think there's really a lot of opportunity in tying together and really convergence between the public and private markets.
Yeah, and to your point about transparency and standards around private data, PitchBook's awesome. At the end of the day, somebody is making an investment decision tied to the data they're receiving. So we can put all the disclaimers we want on our data sets that says, do not use this for investment decisions, not marked to be reliable. I think we all have an ethical responsibility to provide the best data possible and the best tools possible, because at the end of the day, regardless what the disclaimers say and whether we have liability for issues, until there are standards and until there is transparency and cleanliness in the data, it's slippery ground to be saying you're providing great data to people that they can derive insights and then trade on when it may not be all that great a data in the first place.
Thanks, Sean. Well, we're going to bring ESG back into the conversation because I guess just once is not enough. The question here is, what are some examples of what we can reliably call robust data in a field as seemingly fuzzy as ESG? We touched on it a little bit, but maybe get a little bit more specific here.
Maybe I can jump in. You know, the challenge with ESG data is that there just isn't a lot of it. It's evolved through time, and coverage is still less than perfect. And this gets to the private market conversation as well. Their best data sets in the United States go back to about 2007. So from an empirical perspective, there isn't a whole lot to work with. You know, as quants, we like, you know, multi-decades of information. We understand that there's issues with the data, that a lot of it's model driven, that it actually isn't real reporting. The only thing I can say about it is it's getting a lot better than it used to be. We're moving toward more standardization and reporting. We are moving toward a much wider breadth in terms of reporting as well. So we just have more data at our fingertips. I hesitate to draw too many conclusions about, especially the return implications of ESG from the data that we have. I think there's a lot more clarity on the risk side of the equation, but we're not quite there yet. We're getting there, though, and I'm confident that over the next 5 or 10 years, we'll hopefully amass something that's a lot more robust, to use the term.
I like your optimism, Mike. Next question. How is the way that data is being monetized evolving?
We have seen a lot of evolution there, where it used to be, it was all you can eat. You know, you get access to all the data, do whatever you want with it. Then it started to move to per something. And if that per something was per user, that's one thing, you know, or per you know, 10,000 rows or some other element like that. We're now seeing data move more and more towards value-based pricing, where people are saying, let me see the data, let me try to derive my own signal, and based on what I see from that, let's sit down and negotiate what I'm willing to pay for that, because I need to try to be transparent about the business value I'm going to derive. So we've seen the model go from very simple, all you can eat, to really complex, which requires some pretty sophisticated entitlement systems to be created in most companies, for companies like ours.
Yeah, that's right. I would add another thing is not recent, but maybe in the past 5 to 10 years, to Sean's point, it's per data point, per company, per universe, right? So I think as a whole, the industry has pushed back on that to a certain extent, looking for more enterprise pricing, right? And this is more at the institutional level. So we've seen a lot of trends kind of in that direction. I would also say the use case, right? If you're listing off, Sean, kind of all the per use case, what are you doing with the data? Are you redistributing it? Is it for internal use only? Are you just using it to supply advice to your client base? So the use cases and the global remit, is it for one of your local offices, for a region, for your global usage? I mean, I think the use case is really tremendously important to think about in terms of how we monetize data.
Yeah, good point. I can just say from the CBOE's perspective, we've gone a lot more towards consumption pricing versus like subscription or one size fits all. So it is that value add, the use case, that determines it. Okay, next question. Who are some of the more interesting emerging compilers and redistributors of data? Morningstar, go ahead, Jenica.
Oh gosh, I'm not sure. I could take that one in a lot of directions. There are plenty. There really are. So keep your eye out there because it evolves every day.
Sean, Mike, any comment on emerging compilers or redistributors of data that have caught your eye?
When I'm trying to keep abreast on all the crazy data sets that are out there are a couple of sites that are, resellers of this data, Yipit Data or ThinkNum. You go out there and you're just fascinated by the data sets that they have, and the fact that In many cases, they're getting these data sets from entities that you've heard of, but in most cases, it's not. It's from a garage of somebody who said, I've got an idea on a data set, and I've got some really smart people and a whole bunch of Mountain Dews, and this is what we do for a living. And they're trying to do what Jenica and their team do at the macro level. They're trying to do at the micro level on a very unique data set, you know, like the ones we talked about earlier, the car inventories, or the number of open seats on airplanes, or the parking lot density data. They're doing that, putting it up on a site like that, and then seeing if they can monetize it.
I must get 6-7 emails a day from data vendors saying, hey, we've got this great data set. It's got all this predictive power. You know, look at this sort of out of sample statistics on how, you know, great predictive power it is. It is a bit overwhelming. And when you take the time to really go through and digest some of these things, you know, for us as quants, I talked about it already. I'll talk about it again. Coverage is absolutely key. The reality is that, yeah, there's some good emerging data sets out there, but a lot of them have a small coverage. You know, they cover a handful of securities or a handful of issuances on the fixed income side. That's really not good enough for, you know, a quantitative implementation. So we put a lot of weight, well, tremendous weight behind the level of coverage that any new data set would provide.
Makes sense. This is a question about mentoring. Many of us have had the opportunity to mentor young people. If you were to recommend a path to your younger self, would it be to understand the financial industry first and then programming, or vice versa?
Maybe I'll take a stab at this. It can go both ways, right? And I'm not going to cop out and say both. If I had to make a choice, I think it would be the technical skills and the programming. I mean, candidly, I had no idea I was going to be in the data industry when I was in my early 20s. And so, but I do think that technical foundation, starting out in mathematics, right, studying quantitative analysis, it's really those technical toolkits that you can leverage in a lot of different ways. And you have to stay abreast of the changes in technology. You know, I was in Perl and C++, as I mentioned, and no one's really doing that much these days, but there's a literacy there, right? And that skill is marketable and can be applied to many industries. So I would probably vote to start there.
Totally agree. It's the hard skills that are the hardest to teach. So if you have the logic of programming, even if you don't program every day, if you've got the logic in the back of your mind, that's going to help you tremendously in this industry. So I would focus on the programming side first. We can teach people about the derivatives market, or, you know, factor-based equities or fixed income. You're going to pick that up along the way. But if you have those hard skills behind you, then you're valuable.
And I would just like to quantify that, because I couldn't agree more with you guys. If you're coming out of a top-notch university with a computer science or an MIS degree, you're probably commanding $125,000 to $135,000 a year right now. Like, that's pretty fantastic. I've told both of my kids you're taking programming classes for the next several summers, because, you know, you're going to pay for your own college education.
That's great. We have time for one more question. Of course, it's going to have Elon Musk in it. So it's really just a yes or no, maybe a small answer to the question. The question is, can we trust? So trust is the key word. Can we trust data sourced from non-traditional, disparate sources like Elon Musk tweets?
Go first. No.
Depends on what you're looking for.
John?
I think you may be able to trust it in the short term in the Reddit phase. You better not rely on it over the long run.
Awesome. Good answers, you guys. I want to thank all of you. This was just fantastic fun. I loved hearing your perspectives. It's an honor to have moderated the panel. I have one more message before we leave the audience, which is beyond a thank you to all of you. At the end of this event, you will see a notice to complete a survey about today's event. Your feedback helps the society when planning future events, and your feedback is really appreciated. So if you have any questions about today's event, please contact the CFA Society of Chicago office at info@cfachicago.org. With that, wish you all a great afternoon. Thanks so much, panelists. It was awesome.
Thank you.